So the last thing that we have on this chapter in the slideshow here, there is an example. The example here is from the text, paragraph 13, 163. Now, one thing I can kind of promise you guys on this section, I'm not going to, give you guys the most complicated question in this category, but I am going to want you to be able to do some of these basic calculations, right? Make sure to, appropriately calculate your refundable taxes and how much of a refund there would be, your balances in your refundable dividend tax on hand accounts. So some of the basic calculations with that. You'll notice in assignment 2 is not as big as assignment 1. Shouldn't take you as much time. I went pretty light on this section. So I know we kind of time constraint here leading up to the final exam, and I want you guys to be able to get that done. And then also prepare, go through the solutions and whatnot and prepare for the exam. So, but, it could be a little more complicated question than what was there on the assignment. So this one here, this is kind of a basic situation. This kind of rolls through and gives you all the calculations, an example of all of that. So this one, uh, 13-163. Let's try to. Here it is. So this is on page 672 of the text. If you're looking for this example. So it runs through the text there, gives you a good example of how you would kind of crunch these numbers. So certainly this section's not fun. Hopefully this lecture gives you at least some context as to what we are doing and why we're doing it. But this, a lot of corporations are going to have some investment income. So it is something that you will have to learn how to navigate. So let's have a peek at this one. So Fortune Limited is a Canadian-controlled private corporation. Based on the formula, 90% of the company's income is earned in a province. The following information is available for the year ended 2019. So remember how that affects where the province, or if any of the income isn't earned in a province, that can affect your calculations. So in the text, they basically gave you all the different components of the taxable income, gave you the opening balances, to the refundable dividend tax on hand, and all of the relevant kind of accounts that you would need to look at. So all that basic data is provided. All the opening balances, right? So the end of 2018 is our opening balance for 2019. This is all the same data that's in the text. So we know that our GRIP, our general rate income pool, opens at 20,000, and we know that eligible dividends paid in 2018 were 8,000. So there's our GRIP at 12. We have eligible refundable dividend tax on hand is going to be 4,600. How did we get there? It's the lesser of our transitional number and 38 1/3% of GRIP. So we had to calculate that and then do 38 1/3%. Over on the non-eligible side, we should have here opening RDTOH balance 23,000. This is towards the bottom of page 672. And then the opening GRIP balance of 4,600 gives us our 18,400. So in this question, we have a calculation example of your part 1 tax payable. So the wrinkle we've added, right? So we know the abatement issue here with the 90. We learned that back in chapter 12. But the thing we've kind of added here is our additional refundable part 1 tax. So we have to remember to calculate that, as we talked about in the slides. So you go through, pick the appropriate ones, do the lesser of, and there it is. So there's an example of that calculation there for you guys if you want to go through that. So remember that ART, that refundable part 1 tax on investment income, that additional amount that gets added, that becomes a part of our tax 1 payable. So this is adding a little more wrinkle to what we were learning and calculating back in chapter 12. And this is a tax on the aggregate investment income, which was basically like everything but dividend income, and it's 10 2/3% of that number. Also, it's the lesser of aggregate investment income and the amount of taxable income. So if you don't have any aggregate investment income, well, then you're not going to have any of this. So that's just capping it off. So make sure, though, that you do show all of your work, meaning when you have a lesser of, whenever you have that lesser of, do both calculations and then pick the lesser of, just like they did here. So, for example, if we break down the calculations that we have here, they're both 10 2/3, right? And one of them is aggregate investment income. Our net capital gains reduced by any capital loss carryovers deducted, interest, rents, royalties, excluding any dividends that were deductible in calculating taxable income. So in this case, ignored. That was the 30,000 in this question. So, and when you're, for this example, you probably want to pause the video here, have a good look. It's a few pages long, give yourself a familiarity with the question, because I am kind of just skipping through this kind of quickly, but the aggregate investment income is what we're calculating right here. So the 100,000 is your Canadian source investment income. That's 100,000. Then we also have 20,000 of gross foreign non-business income. We also had 30,000 of portfolio dividends, but those were deducted for tax purposes, meaning they were taxable in Canada, so we're ignoring those ones. But we did also use a $15,000 net capital loss carry forward as a deduction. So those are the three components, the 100, the 20, and then reducing by the loss carry forward that we used. That's our aggregate investment income, and we multiplied it by 10 2/3. That happened to be the lower in this calculation, and so we chose it. But that's an example of a question where you're calculating that aggregate investment income for purposes of Part 1 tax payable. Now remember the first part, the other thing we compare to, this was back on slide 13 if you want to refer to it. We had the corporation's aggregate investment income times 10 2/3%. So we just did that. That's the second row. The first row, what this represents is that amount, if any, by which the corporation's taxable income exceeds the amount eligible for the small business deduction. So this is just taxable income minus how much we're eligible for small business deduction, multiplied by 10 2/3. So the taxable income that's in the blue bar in the middle of page 672, 265,000 minus, now it's not always going to be 500. Maybe you're sharing it, whatever. In note 1 on page 673, there is the calculation that we learned in chapter 12 about our small business deduction. So that one had 3 options, and active business income was only 150. So that's why we're subtracting by 150, because that's what we ended up having as our limitation for small business. So you're not always limited to 500. You have to look at those 3 options in the formula. So you would have already had to have calculated that to be able to do this. So we picked the lower of these two, and there it is. What else do we have going on in Part 1 tax? Foreign business credits have to come out, right? If you've paid foreign taxes, you'll notice on page 672, there was foreign non-business income, 15% of 20,000. That's our 3,000. And there was gross foreign business income with 15% withheld on 10,000. That's our 1,500. So this foreign tax, it's been withheld at source on the foreign earnings, so we can claim a credit for it so that we don't have to pay that same tax twice. Same kind of concept as what we learned back in tax 1, where we said, Canada wants to be paid tax on your worldwide income, but if you paid tax in the other country already, you can claim the credit for what you paid. But say if that company or that country had a 10% tax rate and Canada has a 20, well, you paid 10, but you still got to pay the other 10. So it's the same sort of concept here with the corporate stuff. Small business deduction, we've got that as question marks there. Here's the calculation of that. And that's same thing is provided on page 673 of the text. That's what we were talking about a moment ago. These are the same 2 foreign credits. So this right here is just the formula that's provided. All you had to calculate was those 2 withholding amounts. So one was 15% of 20,000 and one was 15% of 10,000. The rest of this is just plugging into a formula, factoring in those foreign credits in relation to the taxable income in order to get to small business deduction. So they factor those in for that part. So we know already we ended up at the 150 because that was the lowest number. And that was calculated as active business income. Once again, showing that Active income is going to get the preferential treatment. As soon as we start involving a whole bunch of passive income, such as investment, we're going to have a less preferential treatment as far as the Tax Act goes. So now we can, these slides are just kind of slotting in these extra things as we go through. Everything's the same. And then, whoa, what's our general rate reduction? Well, general rate reduction is the one we're always going to calculate at the end. And we're always going to subtract everything else that we've already kind of worked with until we know that all we have left to pay full rate on is going to be the 10,000. Our GRR rate is always 13%, so it's just 13% of the 10,000. Taxable income minus the amount that was applied for small business deduction, minus, here's the new wrinkle we're adding, minus aggregate investment income, because it's had its own treatment. So the only one that you're getting the 13% reduction on is the 10% in additional. There's no, so effectively what this is saying is there's no 13% reduction for small business income because you're already getting 19%. So you don't need it. Don't worry about it. And for the aggregate investment income, we've got a whole different set of rules here that we're dealing with this, with potential refunds and extra taxes and all that other nonsense that we've been learning in Chapter 13. So there's where we end up in that example in the text for Part 1 tax payable. So again, I gave you guys a little bit easier question on the assignment, but you will need to be able to potentially calculate things such as what's in this example. And the only wrinkle we've really added here is that refundable Part 1 tax that we calculated. So that's something new to add to what we learned in Chapter 12, coming to that same number, Part 1 tax payable. So it's the same number we learned in Chapter 12 with a new little wrinkle added to it, when and where appropriate. So that was 11,200. Taxed, the rate is built right in there. So this is an add. Notice the way we've always been taxing this is, or calculating this is, figure out the big number, here at 38. And then we're subtracting, just keep, some of them are called deductions. I don't love that word for this, but we're reducing. They're reductions. They're almost basically tax credits. Reducing it. This one, we're adding. So just be careful to keep in the proper order so that you can calculate your rate reduction, because that part will factor in, or the aggregate investment income will factor in. But make sure you're careful with the fact that we're adding this one. This is not a reduction to tax. We're adding a refundable amount to the calculation. So that's everything in that example, getting us up to Part 1 tax payable. So the Part 1, that was our Part 1 payable. Now what about our Part 1 refundable? So refundable is 30 2/3% of our aggregate investment income. So we already calculated that. We know it's 105, right? We calculated that back here, 100 plus 20 minus 15. We do have to do a little more work on this refundable, though, because of the foreign content. the foreign non-business tax credit's going to come out. And this over 8% foreign investment on the 20,000. These offset each other for a net negative of 1,400. So our refundable tax is 30,800. So the little extra wrinkle there is that we have some foreign component to deal with. So this, just to clarify here, this part one refundable, we are calculating here in these slides. I'll just call it 1, then 2, then 3. So the refundable portion in this case is equal to 30,800, which is the least of the preceding 3 amounts. So this is as per, the rules, what we're going to calculate these 3 different totals. And again, it's a lesser of based on your formulaic calculations here that we looked at earlier. So in this case, the first one was the one we were using, but you have to show all your calculations for all 3. That's where you earn the points. And if you make a little mistake along the way, that's okay. You're earning the points by showing as much of that work as you possibly can. So that's everything we needed to worry about for our part 1. We calculated our part 1 tax. We calculated our part 1 refundable by doing the 3 calculations and picking the least. And then we got to deal with our part 4 refundable. So on the portfolio dividends, which was 30,000. So again, the portfolio dividends are just dividends from Canadian companies that we are not connected to. Basically, we've invested in some, tax-paying Canadian companies. We have deducted that from our calculation. It comes out of our net income for tax purposes to get to taxable income. They are not taxable at that level, but we do have, as these dividends, again, they're flowing through, right? So you have the corporation, the corporation that you invested in. I'll just call this Invest Corp. So you as the corp have invested in this. You own shares. It sends dividends to the corporation that you're doing the taxes for. I'll call this Tax Corp. So because these guys already paid tax, right? They already paid tax. So we don't have to, so there's no more tax here. But as we're receiving it, we may have to do some of this refundable tax because we want to eventually get this money, the Tax Act, to the, the individual taxpayer, right? The actual human being. When dividends are paid here, this is when we're going to get that last part of the tax, right? So they paid corporate tax. We need to pay the personal tax. Through here, it's not going to happen. This is just a flow through. So in order to disincentivize the flow through without getting all the way through, we have this additional tax, but it's refundable. You can get it back. You just got to pay out those dividends. That's what this has all been about. So on the 30,000 in this example, you've got 38 1/3, or sorry, on the 30,000 of portfolio dividends, it's 38 1/3% of the 30,000, giving us 11.5 of refundable Part 4 tax. So then, after with all of that's figured out, now we're talking about our balances in our refundable dividend tax on hand. So wherever you see this transitional balance, that's just talking about how we broke that balance into two at the start. If I give you any questions, I'll kind of give you, I'm not going to make you guys calculate the transitional balances. I will just give them to you, if it's in the question. So here, the transitional balances are available for the eligible RDTOH. We put the Part 4 tax on the eligible dividends. That's the 11.5 we were just looking at a moment ago. Those were eligible dividends. That should be mentioned here in the question. The portfolio dividends would normally be eligible dividends. So that gives us our balance of eligible at the end of the year. Same thing, starting balance. We calculated our Part 1 tax. We add that in. That gives us our ending balance. And then we can look at our GRIP. Opening balance is given. We received portfolio dividends. Those are getting taxed at the high rate. So those add in. So now we have 42,000 in our general rate income pool, income that can be paid out as eligible dividends. Get a bit of a preferential tax treatment because higher tax rates have already been paid. The dividend refund. If we have an allocation of 60, 42 designated as eligible, the remaining 18 designated as non-eligible. Remember, because we are tracking an eligible pool and a non-eligible pool, when we pay the dividends, we are going to, we always have to keep track of those dividends regardless, but as we're paying them, that's going to affect our dividend refunds because the refundable tax on hand is in two pools. It has to come out of those pools. So then we can do the dividend refund. For eligible is the 42,000 paid. So 38 1/3 is the rate, the refund rate. Remember, it's the exact same as the taxed rate. So 38 1/3 on the 42, the lesser of that, and the ending balance that you have. So in other words, we only have this in the pot for eligible refundable dividend tax on hand. So that is, well, I guess best way to just simply put that is that's what we had, 16,100 in the pot. So that's all we could pay anyway. So that's all we should pay as the 42. 42 times this is 16,100. So the lesser of the two of these is the same number. So we subtract that out to get, at that point we've used it all up. We wouldn't want to go further than this because there's nothing left in the pot. And then you have the refund on the non-eligible, lesser of, same. We called 18,000 of it non-eligible. So 38 1/3 times that. But we have to compare that to how much is in the pot. Well, we got lots in the pot on the non-eligible side. So we just pick 38 1/3. So the only reason why we're doing lesser of here is to limit it to what is in the pot, so to speak. And again, we have two pots, a non-eligible and an eligible pot to draw from. So when we take all of that and figure out our total federal tax payable, where are we going to end up? Well, we calculated our Part 1 tax payable at $53,750. We calculated our Part 4 tax payable at $11.50, and then we calculated the two different streams of dividend refund for a total of $23,000. So it's Part 1 plus Part 4. Inside of this one, by the way, was that ART, the ART, right? The additional Part 1 stuff. And we had the Part 4 stuff. So all of that added together, minus the refund that we can claim because we paid out dividends through those two channels, leaves us at our total federal tax payable for the year. So obviously you can see here from this simple slide that we were able to recover, due to the dividends, $23,000 of the tax. So if we slide back, how much was our ART? I forget what the number was here. Oops, yeah, Part 1 refundable. The ART was $11,200, I think. Yeah, because it was the lesser of doot and doot, 11,200. We had to do these 3 slides. Oops. So we picked 30 there. That was our, sorry, that was our Part 4. Yeah. So our ART ended up being 11,200. So if you look at this, really what I was trying to get at here, all the way back to the end, inside of there, I believe we had 11,200. So, you know, 22,700, you could say, right? If you add the 11,500, just to give it a little context here, this isn't part of what it's asking, but you know, that's like 22,700 of extra taxes. But then based on what was paid out, we were able to recover 23. So these things have kind of wiped each other out to a large extent. One of them is buried inside here, so it's not apparent when you just look at this one simple slide. But you've paid some extra ART and you've paid some extra Part 4, both of them being refundable. You paid out dividends, so you got refunds on the 2 channels of your general rate and your low rate income, and it kind of mostly washed in this question. So you would, as far as a tax planning concept, you would look at how much of these refundable taxes you're going to have to pay, and then use that as a planning tool for how much you will pay out in dividends and what type of dividends based on what you have. So being able to do all of this sets the groundwork where you can plan out these dividends so that you can lessen the impact of this. And that's the whole motivation of these elements being in the Tax Act, is to just move that money along through the channel. Simply increasing the tax rate would be too much. You have to have this built in to promote for the owners of the business to push that through to the ultimate taxpayer, that being the individual. So that example kind of is I guess that's the extent of the complication that you guys could possibly expect in the midterm. The assignment question's a little bit more on the easier, shorter side, just so you guys weren't too bogged down. I know the first assignment was a little on the longer side, and I didn't want to go too big on the last one there. So that's it for chapter 13. There's a few pointers here, procedures on working through bigger questions. That's it for chapter 13. On Wednesday, we'll have a look at chapter 14, which is the last part, and that'll help you with the last couple of questions on the assignment. We will do a small in-class exercise, basically just having you guys try to work out some of these. Like the big part of that is the associated corporation rules, and trying to figure out if a couple of companies are associated for purposes of the small business deduction. So I'll just give you guys a little exercise to work out on your own or in a group, and submit in tomorrow night. Just kind of practicing, getting you guys actively working on some of those type of questions. But we'll also go through and kind of explain all of that and how it affects small business deduction and that sort of thing. So chapter 14 is called Other Issues in Corporate Taxation. So it kind of just picks up on a few other topics, a lot about control, and the associated corporations is going to be the key stuff that we'll focus in on chapter 4, and then we will be all ready for the midterm on Monday. As always, if you guys have any questions about this lecture or any of the other stuff, any of the assignment questions, any of this, please feel free to shoot me an email, and I'll try to get back to you as quickly as I can. So that is it for chapter 13, and I will see you all on Wednesday.